Investors Chronicle.
Hello and welcome to the latest episode of the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle, and today we have a very special guest. Cathie Wood is the chief executive of ARK Invest, a name that became famous in the dark days of the pandemic, when its bets on the likes of US growth stocks and some notable lockdown winners generated some huge returns. Since then, of course, the ride has been somewhat rockier. The flagship ARK Innovation ETF has gone through some difficult patches at times, partly in the face of interest rate rises, and some claim some issues with the investment process itself. ARK's products are now available in the UK after the company bought a European firm, so investors will be eyeing those portfolios up pretty closely. So, Cathie, thank you for coming on. How are you doing?
Great. How are you, Dave? Thank you for having me on.
Pleasure. I'm very good, thanks. Let's get stuck into it, perhaps looking at the Innovation ETF, kind of the flagship name, the best known product, I guess. It is notably concentrated. When I looked recently, the top 10 holdings made up around 60% of the portfolio. So it'd be good, first of all, just to get into some of those prominent names. Tesla is a holding you guys have kind of long been associated with, recently made up around 10% of the fund. It has had perhaps quite a tricky start to the year. There have been concerns about it being undercut by the likes of China's BYD. But Tesla is supposedly kind of bringing out a cheaper electric vehicle in time. What's your kind of take on that? I mean, do you think cheaper cars is the kind of way forward for Tesla? Can they actually compete when it comes to pricing? And what kind of edge does the company now have?
Yeah, so during bear markets, and we went through a vicious bear market in both 21 and 22, we tend to concentrate our portfolios towards our highest conviction names. And then during bull markets, last year was a very good year for us, we start to diversify. So we are more concentrated than I would say we are on average. So 60% is at the higher end. And yes, Tesla's the number one position. As far as EVs, we think that's a very small part of the story. Autonomous is the story. But let's start with electric vehicles, since you mentioned BYD. We know BYD is very aggressive in pricing, and the cars are pretty good. And yet, when we think about the risks around BYD, we think they are much more risks to traditional internal combustion engine companies as the world goes electric. And we believe that the share of EV sales going to electric will increase from roughly 10% now, a little over 10% now, to 75% in the next 5 years. So there's going to be a lot of room for both Tesla and BYD to traverse, because they are the two most competitive EV manufacturers in the world. And so we think both will gain share from internal combustion engine cars, and that these share gains are going to be pretty magnificent, going from 10 to 75% or more in the next 5 years, we think is going to give them both some very big gains on the EV front. Now, in terms of Tesla, and this is different from BYD. BYD is not, to the best of our knowledge, is not pursuing an autonomous taxi network opportunity. And this is the largest AI project on Earth. By our calculations, the entire autonomous mobility, meaning personal transportation market globally, including China, will generate $8 to $10 trillion in sales in the next 5 to 10 years. And we think that the taxi networks, which are going to host autonomous taxis, are going to get half of that pie, so $4 to $5 trillion. That is where Tesla is playing. That's the biggest opportunity going forward. And we know that we're getting closer Now, to be fair, Elon has been saying for the last 6 years that we're within a year of autonomous. And of course, he's been wrong. Interestingly, in I think the first quarterly earnings call this year, he acknowledged, look, I've been wrong for the past several years, so I'm not going to give a forecast. Well, that actually told us, believe it or not, that he's probably getting very close. And sure enough, Tesla announced something called unboxed manufacturing, which is for EVs, but in the same plant, Tesla is going to be able to produce human-driven cars and robo-taxis, and we'll be able to flex between the two depending on the demand. So just to give you a sense of the opportunity here, when I'm in an Uber car, I often say to drivers, you know your job is going away. And here's a good idea for you. You and all of your Uber friends or other friends should buy as many Teslas right now as you can, because you will be able to leverage off Tesla's platform as it launches its autonomous taxi network, and put your fleet, however many cars you buy, and just send them out and do the work for you, and they will be cash cows. By our calculations, these people could pay down their cars in a few years if they just sent their cars out for, I think at the time our calculation was 5%, but they could of the day, but they could send it out for 50% of the day and pay off the cars very, very quickly, and then generate very nice cash flows. That is where we believe the world is going. And when we say Tesla is the largest AI project in the world, what we're saying is not only the revenue generation, but the positioning. In order for a company to win in this space, it needs to meet 4 characteristics. And this is true of anything having to do with AI. It has to have deep domain expertise, and it has to have AI expertise, has global distribution, and then most important, proprietary data. Tesla it now has 8 million robots on the road, right? I have 2 of them, a Model 3 and a Model Y. And every day my cars go out and collect data about my driving and disengagements and so forth, sends that data back to Tesla. And with the advances in AI, we are now seeing software updates every few weeks. And in the UK and Europe, you don't have these software updates. Regulations will not allow them. So unless you've been in a Tesla car in the US recently, you won't understand what I mean. And what we're seeing is step function improvements in the ability of a car to drive me, or my car to drive me from point A to point B without my disengaging at all. So we think we're almost there.
So you mentioned, I suppose, the hot topic of kind of AI, which, many fund managers are currently talking about the extent to which they are kind of targeting it and accessing it in kind of different ways. How kind of sensitive do you feel, for example, the Innovation Fund is currently to AI euphoria, but also, I suppose, AI gloom, because that tide could perhaps rapidly come in?
Right. So yes, there's a lot of euphoria now, and we're seeing in Nvidia's results huge demand for to build out capacity by data centers. So certainly laying the stage, we think, for some massive productivity gains. That's the biggest use case, I think. Almost any company will be able to harness AI and increase productivity We think knowledge worker productivity is going to go up fourfold by 2030. If you look at our flagship strategy, what you'll see, and we break out AI exposure by company to get this number. Our flagship, ARKK, is 43% exposed to artificial intelligence, but across sectors. This is not just technology. I was just giving you one in the transportation sector. That's the largest, as I said, AI project. And we, if you look at how do we break out Tesla, 25%, although I think this is going to change a bit in our next model when it is released, and we do release it to the public, 25% EVs and 75% AI. But as we are getting closer to AI and actual launching of the service, we think that AI exposure is going to go up in terms of the valuation attributed to AI from Tesla. I wanted to make one more comment on Tesla. If you look at proprietary data, Tesla has orders of magnitude more data on real world driving miles than all of the other auto and tech companies put together, who are focusing on this space. And the company with the best proprietary data, it's not necessarily the amount, but it is the number of corner cases that Tesla has been able to accumulate. A corner case is when I basically brake, and because the car's not doing what I want it to do by itself, it is learning from those. So Tesla has more corner cases than all of the tech and auto companies combined. So our price target for Tesla is in print for 2027. It's at $2,000, and today the stock is at $178. So we see more than a tenfold increase, and that's by 27. As we push the model out, which is what we will be publishing, of course, we expect the uptake to accelerate the further out we go.
You're obviously very bullish on the stock, and that's represented in its position in the fund. But what would be, I suppose, your main concerns? Are there any kind of risks you're looking out for? To name one, there are questions about whether Tesla can continue to kind of straddle the US and China and deal with those kind of tensions and so on.
Well, it's very interesting what has happened recently in China. The Chinese government has, I don't know if it invited Tesla in to work with Baidu on its Apollo system, which is its autonomous system. It's clear that Apollo is not making the strides in full self-driving that Tesla is. We never thought that they would allow Tesla to do much of anything autonomous in China because they're so guarded with their data. They're very, very focused on keeping their data inside China and letting no one have access to it. So here, in order to help Baidu, Tesla is going to have access to a lot of real world driving data in China. And so if anything, we think that the Chinese risk has gone down. And now, why would this be, given the geopolitical dynamics between the US and China? We think China knows that autonomous mobility is the next big wave in transportation of all kinds. And we also know that China is trying to change the subject from the real estate collapse and the overwhelming debt load of the country. And they're trying to grow their way out of it through innovation. This is an important project for them to show success. And I do think they will reverse engineer whatever Tesla does. That's probably what happened with the EV market as well. BYD probably is more competitive today because China was able to reverse engineer the Tesla cars in China. So
Makes
so
sense.
we think that Chinese risk has actually gone down. And I know most people are surprised to hear that, but we were surprised that Tesla was invited in for autonomous.
Interesting. Let's move on to some other prominent holdings that are very, I suppose, topical. People have lots of different opinions on. To name a couple, there's kind of Coinbase and Robinhood fairly prominently in the fund. How much do you accept that? I suppose, some people might worry that the fund could almost be a kind of Bitcoin proxy, given the effects of kind of the price on those stocks. And how do you manage that?
Well, that gives you a sense of our conviction in digital assets. This is a whole new world evolving. But when you mentioned those two specifically, and actually there's another one, Block, which owns Cash App. You may know of Cash App. We think those three companies are in the running to be the winners, and some will win more share than others in the digital wallet space. So a digital wallet is, the shortcut way of explaining it is a bank branch in our pockets or our pocketbooks. And we've learned a lot from WeChat Pay. It skipped the bank branching system and just went online to online banking. And now Coinbase and Robinhood and Block are coming at this opportunity from different angles. Coinbase is starting with crypto or digital assets. It's starting from that angle. And yesterday just announced that it is going to enable oil and gold futures trading on its platform. So that's its first non-digital asset play. So validating what I just said, that they are going to spread their wings. Now they have miles to go in the digital asset world, and they're gaining share because the competition, in many ways, one of the competitors imploded. Of course, that was FTX. Binance has been under tremendous regulatory scrutiny and has been fined. So Coinbase has been gaining share, not just in the US, but around the world. I think it has 110 million users, and it is spreading rapidly throughout the world, starting with its derivatives products, which the SEC would not allow in the US. So they started their derivative products in Bermuda. And they're moving quickly into other countries as well, with good success. And one of the reasons they are is because of all of the drama around FTX and Binance and, everything that did go wrong. It is being recognized as the most regulatory compliant exchange in the world. And I think it's gaining share because more and more people trust it. So that's critical. And we do think, as you know, our Bitcoin forecast is out there, and our bull case was in the $1 to $1.5 million range by 2030. And that bull case has been, our confidence has increased in it because the SEC did give the green light to a spot Bitcoin ETF. So that's the first sign of regulatory acceptance. And interestingly, because digital assets, crypto, that is becoming an election year issue here in the United States. And we just saw a bill pass the House. It's the FIT 21, and it passed with many Democrats supporting it. What that tells us is, this is an election year issue. And the Republicans have the issue on their side. In fact, former President Trump is accepting campaign donations in crypto now. And that triggered something else just this week, which is that the SEC is now fast tracking a spot Ether ETF. And we're second in line to get, so we know a lot of what's going on. We assumed it was dead, but once President Trump, or former President Trump, accepted campaign donations, it went into fast forward because this week was the deadline. So lots of interesting dynamics, but much more acceptance now of digital assets. So pretty excited about that.
Yeah, interesting. I'm going to go into a couple more names and then we'll speak more broadly about the kind of portfolio and the process. One name that perhaps intrigues people to see in the portfolio I suppose in 2024 is Zoom. For me, that kind of still, perhaps would be regarded as kind of a lockdown play. Fast forward to now and we have kind of more in-person interaction. And we also have kind of, the likes of Google, Microsoft and so on operating in the same space. That's very competitive. What is the growth outlook there and what's your kind of rationale for holding?
Yes, so we have taken the position down in the portfolio as we have seen Microsoft being forced by Europe to unbundle, has undercut Zoom's price for its service. But if we look at what happened to Zoom, it went from, during the COVID, it went from 20 million users to 200 million. So no marketing there. That was a very fast ramp. And it has been dealing with, yes, people going back to work, and we've tried to look beyond that. Our conclusion is, that Microsoft absolutely has enterprises. It owns enterprises in a big way. Enterprises don't want to be beholden to just one video conferencing service and contact center service and phone service and so forth. So Zoom is becoming a fallback, even for enterprises. We, for example, use Teams inside our Arc, but for outgoing calls, we're much more focused on Zoom because it's the better service. And when you think about outgoing calls, what's happening from company to company? Well, very often those are sales calls, and you want the communication to be the best, and if you're trying to close a deal. The other thing is, yes, people are going back to work, but there is a hybrid work world now. And as long as one person in an organization is out, you're going to have to accommodate remote work if that person needs to integrate with the rest of the company or with other companies. The big opportunity here is in small and medium business. They are not hostage to Microsoft. Microsoft doesn't really have much interest in them. We've been watching Zoom when it comes to AI over the last 4 years, and looking at their patent applications and so forth. And they've been prolific. And now they're starting to roll out lots of new products with AI at the center. And we think that's going to be a boon for the small and medium business. Nonetheless, we did think that Zoom had a shot at more of the enterprise than they're going to get now. And so we have taken it down. I do like to focus on companies that focus, and Zoom is very focused on the workplace, enabling, faster, better, cheaper, a much more agile company than Microsoft. Now, Microsoft copies a lot, and so that will preclude a huge enterprise presence. But there's a lot of work to do in the SMB world.
Yeah, so you mentioned Microsoft, and turning to another kind of very topical area. People are talking about the Magnificent Seven or perhaps the Magnificent Six after Tesla's kind of rough run recently. But turning to those stocks, it does seem you have some small positions in the likes of Meta, Microsoft, Nvidia. But what would you need to happen to kind of take material positions in those kind of companies and for them to be perhaps as prominent as names like Tesla in the portfolio?
Well, in the US, according to Morningstar, the average large cap active manager has 45% of its portfolio in the Mag 6. And as you rightly said, we have a much smaller position. So they're very concentrated in that area, and it has been a good place to be. We have been dialing down our exposure to the Mag 6 because the rest of our portfolio is brimming with bargains. As there's been a crowding into a few stocks, which is emblematic of it's a flight to safety, a flight to cash. These companies also happen to benefit from AI. They also might be disrupted by AI, and we can get into that. They're certainly Google is on red alert because chatbots don't need to go into its search engine to find the best shoes at the lowest price for no delivery fee from a site in the Western Hemisphere. They can just find that site. So there is disruption in brewing. Same with Amazon. You can just go directly to a site. You don't have to go through Amazon because you might find something cheaper, or the chatbot might find something cheaper on a website, on a reputable website. So just those are just some ideas of disruption, and same with Apple's app ecosystem. So there's some disruption possible, but they are in a good position with installed bases and can pursue AI opportunities. No question about that.
You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
If you look at the history of crowding in, and the Mag 6 is definitely crowding in, you'll see that it has happened right before either very good times in the market or very bad times in the market. The first two dates I saw of significant crowding in were 2000 and 1973. And I said, uh-oh, that was a harbinger for very bad times ahead. But if you look at all of the peaks, you find that they are more often than not, there are not that many of these extremes. But I think 4 of the times you would, if you had diversified your portfolio away from whatever the concentration names were of the day, you would have done very, very well. One of them, just to give you an example of how extreme the situation we're seeing right now is, one of those times was during the Great Depression. So in the early years of the Great Depression, so 29, 30, 31 into 32, there became a big crowding into cash-rich companies that were going to survive, right? Much like there has been in this interest rate environment. In fact, it's been more extreme this time than it was during the Great Depression. If you look from 1932 on, what happened is a diversified portfolio, moving away from those crowd-in names was the winning portfolio. And so that's what we think we're setting up to do if we're right that interest rates are in a plateauing mode now and will come down. And we do believe interest rates are going to come down because we think inflation is going to be coming down much faster in the future than people expect. A lot of it is because of AI and the massive cost declines that we're seeing in anything that AI touches. So AI training costs are dropping 75% per year. And so we're getting a lot more of AI as a result. This is a very deflationary, it's good deflation. It's going to lead to booms in unit growth. But it is also going to lead to creative destruction. We talked earlier about EVs versus gas-powered cars. We think gas-powered cars are going to have to cut their prices. We think they've already started because EVs are becoming much more competitive. and are falling below the price for gas-powered cars in many situations.
Interesting. I suppose kind of one question is, and this is always the difficult question, you talked about the kind of accrual of returns to just a handful of stocks and the points at which this can turn. Obviously, that's kind of been a debate that we've had for many years, and those large caps have generally tended to sort of continue to plow ahead. I mean, is there it's always a tricky question, but is there a kind of catalyst that you could see in the horizon? Is there any reason you can actually see for things to kind of turn around?
Yeah, I do think it is inflation and interest rates, and it's the big debate out there today. Our strategies this year have been hurt because expectations for Fed easing moves went from 6 for 2024 to at 1.0. Now they're moving back and forth. There's a big debate. But what we're seeing in the underlying economy, the headline numbers say one thing. Underlying economy, if you look at small businesses, their optimism and the surveys about where their businesses are, they're at 0809 lows because they cannot get funding. Banks will not lend money. There's huge risk aversion out there. The consumer sentiment is relapsing. I think part of it was gasoline prices went back up, and consumers are really strapped. They're having to work more than one job now in order to make ends meet. So underneath these, seemingly positive headline numbers is a lot of pain in the economy. And we are in an election year. The Fed is independent, and we do believe it is independent. It's certainly acting that way right now because it's so tough. But we believe that the Fed is going to get some signals out there that not all is well. We're seeing a lot of bankruptcies.
I mean, is that kind of general grim as it is, that kind of political tide, is that influencing other kind of stock picks? Is that kind of inspiring other ideas? And beyond what you've just mentioned, is it kind of making you slightly more wary of certain areas?
Well, the area that has been hurt the most by this reversal is what we call the genomic revolution, which is another one of the funds we launched with formerly Rise, now ARC Europe. So the genomic revolution is in terms of the 5 major platforms around which we have centered our research, so robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space, the last one has been the most disadvantaged because it's at the earliest stage of its development, and a lot of companies are not they're not profitable. They will be highly profitable given the cures for disease that they're developing, 2 of which have already been approved in the US, UK, and Europe for beta thalassemia and sickle cell disease. But that hasn't mattered. What has mattered is cash and cash burn. Algorithms are out there, and when there's some interest rate news or fears that interest rates are going to go up again, these are the sorts of stocks that have been hurt the most. And so we have leaned into them. We think the opportunities in this space are life-changing, truly life-changing. I just used the word cure for diseases that were incurable. In fact, you couldn't even treat the symptoms. And we have seen many individuals now cured of them with just one gene edit, just one and done. And so pretty provocative. And there are a lot of names that are enabling this new world, but they've been hurt. And so we have leaned into them, buy low, sell high.
Thinking about your kind of investment universe, I suppose within the Innovation ETF, obviously it's very kind of US, Canada focused. What would anything, I suppose, make you kind of look that much further afield? Are other markets just not particularly kind of alluring? And obviously, I have to ask, with UK stocks, would any particular UK companies kind of stand out as interesting names to hold?
Well, I mean, the UK has produced probably the best AI company in the world, DeepMind, but Google bought it, right? And ARM, of course, SoftBank bought, and now it's public again. So you definitely have the DNA, but I think the issue, and I think it's well recognized. In fact, someone told me that one of your chancellors said that a top priority was getting building sort of a venture capital community so that companies want to stay in the UK and can grow to mega caps in the UK, as opposed to being bought out and helping another company become a mega cap. So I think what's also going to happen here with AI, I mentioned how rapidly the costs are dropping. Um, what that means is the barriers to entry in terms of innovation are also falling. And we think that it's a little bit like what the cloud enabled starting in 2006. Before that, companies, even little startups, had to buy all their own servers, all their own storage, all their own networking gear. But with AWS, they could just rent it. And so the barriers to entry came down, and we had a lot more innovation. I think that's going to be true ever more so with artificial intelligence. So I think that now would be the time to try and stimulate a venture capital ecosystem in the UK and in Europe. I would say in Europe, one of the issues, and we've seen Palantir, one of the AI software companies in our portfolio, say that it's pulling employees out of Europe back into the US because there is a bit of a labor shortage. But the main reason is regulatory. Because of all of the privacy considerations, AI is probably not going to be, the ground is not fertile in Europe to develop AI-oriented companies. And almost every company is going to have to become an AI-oriented company. So that's a big problem. So I know that the UK is not hostage to the European regulations. So that's a good thing. So again, stimulating, encouraging, incentivizing a venture capital ecosystem in the UK, I think would be, I think it would be productive, and you would produce a lot of companies.
Is there, I suppose, some merit, though, to that kind of safeguarding via regulation? And, for example, if the US things are kind of lighter touch, do we then run into problems further down the line when there's some kind of backlash or some kind of ethical issue, that kind of thing?
Yeah, this is a big debate in the US, and I'm happy that it is, because half of the solution is understanding the problem, understanding that large language models hallucinate and very convincingly provide the wrong answers to medical questions and others. So big risks there. And so those who are developing large language models are learning a lot more about prompt engineering and how precise one has to be in asking questions and encouraging a large language model to give the correct answer, go through the right steps to give. All of these large language models have been formulated from human activity on the internet, right? So you'll see a lot of human behavior patterns you have to encourage to get good behavior and good results. So there's it's complicated.
One of the, I mean, there are so many to pick from, but one other interesting area of controversy when it comes to AI is, I suppose, what's now going on with kind of intellectual property. You're having some deals being struck. You're also having names like, for example, New York Times kind of going to court with certain companies over use of IP and that kind of thing. What's your kind of take on that? I mean,
The U.S. is a very litigious society, as everybody knows,
Hmm.
and we could get tied up in knots over this issue in the court system. Japan has recently clarified and said, no, 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 just because the first two notes of a song sound exactly like a song that another artist did 10 years ago, that does not give that artist the right to sue. So they're being very clear about, copyright issues in Japan, and I think that might give them a leg up in terms of AI.
Interesting. And it's interesting also to look at the deals I mentioned. Say, for example, to name our parent, the Financial Times has struck a deal with OpenAI to train AI models on its archived content. Does it seem like those companies with the IP are getting a good deal so far? There are some concerns that perhaps things are being, kind of given away on the cheap or so on.
Well, as I mentioned before, proprietary data is what these large language models need more than anything else to distinguish themselves from one to the other. So that's a hard question to answer because there is also a thought process out there that you can simulate data and for which you pay nothing, and feed models that way. So I think we're going to spend a lot of time in court in the U.S. over this issue, and we'll learn how valuable it is and how much data you can pull from just simulations. So have technology simulate the data. So that remains to be seen. I know that in the world of technology, we saw what happened with the internet. What happened with the internet is people don't want to pay for much. So if these companies were to pay enormous sums for data, they probably might be disappointed on their return on investment. So, but a hard question to answer.
Yeah, like you say, I suppose it'll become clearer with time, hopefully. I did want to kind of turn to I mentioned when we first started speaking that some people have kind of criticized the ARC approach and how the funds are run, and I do remember, it's going a couple of years back, but Morningstar downgraded the fund and kind of warned that it was becoming more exposed to stock-specific risk. There's too much kind of instinct involved in constructing the portfolio and so on. How would you kind of counter those criticisms? And, I suppose, why should people kind of have faith in the investment process?
Yes, well, they need to understand it first. I don't think Morningstar does understand it. And when you say stock specific risk, we're investors. That's what we're supposed to do. We're not supposed to mimic benchmarks, and especially when it comes to the future. You can mimic benchmarks if you're just investing in what has worked and tried and true and all of that. That there's a role for that. But there's another role, which they disagree with us on this, for a company like ARC to say, wait a minute, we're not going to use a benchmark as our guide. We're going to use a white sheet of paper, and we're going to use original research as our guide. So if we give our research away so people can understand the depth of it, we give our Tesla model away so you can see the depth of the actual bottom-up modeling as well as the top-down modeling. And then we have a 6-point or a 6-metric overlay. It's a scoring system. 4 of the scores are, they're all important to innovation, but the first is people, management, and culture. Do we have a visionary leader who will stand up to short-term oriented shareholders and invest aggressively now to capitalize on these opportunities? You need that kind of leader. From an execution point of view, do we have a company here whose management is investing aggressively in the right areas? So we look at R&D. Are they investing enough in R&D as a percent of sales? And if they are, where are they investing? And do we agree with that? And just to give you a sense of that, When Toyota pivoted from an electric future strategy to hydrogen fuel cells, we sold the stock because we had already done the research that the infrastructure build out would be too onerous. We are focused on product and service leadership, so market shares, moats, barriers to entry. That's all about the technology and how these companies are leading the technology. The other companies and benchmarks are going to follow. A lot of them are going to follow the technology that our companies are leading. And then many people say on the valuation front, that is a specific score. What I like to explain there is we use, our chosen metric is enterprise value to EBITDA. Enterprise value, so the entire cap structure. EBITDA, take away the fun and games, so financial engineering associated with EPS. On that metric, we assume that our company's multiples are going to compress to a market multiple over the next 5 years. And in order to believe that these companies are going to be able to deliver a compound annual rate of return of 15% per year over the next 5 years, revenue growth and margin expansion must overwhelm that valuation compression. And just to put numbers on that, today, on that basis, the S&P is valued, and here we do adjust for stock-based compensation, which is very important for innovation companies. So on that basis, the S&P is valued at 19 times. Our portfolios are valued at 29 times. We assume they're going to 19 times. But I have rarely seen a gap that narrow in my investment experience between our portfolios and the broad market. And then the final score is thesis risk. What could come and really destroy the thesis that we have on the stock? So we look very carefully at regulation, other technologies in the pipeline. We have a venture fund, so we know a lot about private companies and other such risks. So we're top down is our starting point, bottom up stock research driven, line by line, as any other team you'll find out there. And then the scoring over provides a robust process. Our 5-year investment time horizon is very different from the traditional portfolio managers. If you look at the way these investment teams are looking today, they're really looking at this quarter and next quarter. We're looking at the next 5 years. And so that gives us a lot of latitude. And if you give us those 5 years, we will tell you with a straight face, we believe we're running a deep value portfolio.
And how would you, I suppose, kind of defend? There have been issues with kind of timings with the fund of buys and sells. Notable one was last year with kind of exiting Nvidia and then the massive rally. What's the kind of rationale there?
So to give you the Nvidia story, we got in a little bit over $4 in 2014 when we understood that Nvidia was an AI play. Most people thought it was a PC gaming chip company. We got in a little over $4. Today it's and we rode it up to almost $400 in the flagship fund. And so that's 100-fold return. I think that's pretty good. And then we were saying, well, wait a minute. If Nvidia is going to continue to run, and we thought it would, but there must be plays out there in the software space that are going to benefit and are not appreciated. In fact, they almost have to benefit if Nvidia is going to continue running. And so we moved into the UiPaths and the Palantirs and other companies that we thought were going to be able to harness AI tools and really lead the charge in terms of enterprise AI. Palantir and UiPath are two of the premier companies, we believe. So, it would be a little bit like asking a small cap manager, why don't you still own Nvidia? Now, we're not a small cap manager, but we're an innovation manager. And we're looking for AI is a big idea. Nvidia, everyone gets that. And they are delivering, no doubt about it. But in order for them to continue to deliver, have to be other beneficiaries. So as I said, we believe 43% of our flagship strategy is exposed to AI, with Tesla, again, the biggest AI project out there.
Yeah. I mean, is there a valid concern that still gives you kind of correlation to, names like Nvidia or so, when if market sentiment does turn, perhaps people will kind of just start selling everything that they view as some kind of an AI play or some kind of a tech play, as broad as that label is?
If we were in a 2000 or a 1973 situation, it would be bad news for everyone. If, however, we're in a 1932 situation, and what we've seen is a crowding in because of interest rate concerns, crowding into cash-rich companies, and the market dynamic changes and interest rates come down, then that should benefit our strategies handsomely. Because I know this is another question asked regularly. So if you look at our compound annual rate of return since inception, it is closing in on 10%, I believe. So we haven't achieved the 15% since inception. But we also didn't expect to have the heart attack that we have seen in the markets caused by a 24-fold increase in interest rates. We've never seen that before. Even back in the Volcker days, the early 80s, the biggest increase was twofold, from 10 to 20%, to be sure, but people were used to inflation, they were used to working around it, they were used to rising rates and hedging against them. This was a shock to the system. Nobody expected that kind of increase. And that is why we're seeing a lot of bankruptcies today. And I think the Fed will get the message soon. And if our strategy, and all long duration strategies, including long-term bonds, were crucified by that rate hike, then the opposite should be true. We should be some of the biggest beneficiaries.
Well, we shall see how that goes. So lots of interesting food for thought there, but I'm afraid we are running out of time. So I'd just like to thank Cathie for coming on, taking the time.
Thank you, David.
Thanks to our very talented producer, Maddie Apthorpe, as always. And thank you to everyone for listening. Take care.